Here's an example of what can happen if you don't pay proper attention to the distinction between probate property and non-probate property. This slide represents a single client who has a child, and the client has prepared a will which will provide that all her assets will pass in trust for the benefit of her daughter. Her estate consists of only $350,000. It includes her home of $150,000 and life insurance of $200,000. Now don't forget, she said she wanted a will prepared that leaves all her assets, that would mean all $350,000, to a trust for her daughter. Although she'll sign her will, she forgets to change her life insurance policy to be coordinated with the terms of her will. A trust could be a big part of any estate plan. So let's talk about trust for a few seconds so you can see why it's a good idea to make sure the life insurance is coordinated with the terms of the will. When you establish a trust, basically a simple concept. All you're saying is that you're giving property to someone named a trustee or called a trustee whose responsibility it is to hold and manage the property for the benefit of someone else. So in this case, the client was giving all her property at her death, don't forget, because a will is only effective at death, all her property to a trustee who is going to manage the property for her daughter. That means use the income and the principal of the trust for the benefit of the daughter until the daughter is old enough to take the property herself. So at this client's death, a full $350,000 would pass to a trustee who would manage it for the benefit of the daughter. But because the life insurance death benefit was not coordinated with the terms of the will, instead of the life insurance going to the trust, it's going to go outright to the daughter. Now, you may think that's not such a bad thing, but when property goes outright to a young person, typically a guardian must be appointed for that young person to manage the property. The guardian might be a different person from the trustee that the client selected, and the guardianship itself is going to be supervised very closely by the probate court. There'll be annual accountings required, or periodic accountings required. A bond will be necessary, which increases the expense. All those court proceedings can increase the expense. But the most important part of a guardianship is that it terminates when the child reaches the age of majority, and that's age 18. In this case, this child would be entitled to receive the $200,000 when the child is 18. Now, most clients think that that's too young an age for someone who's going to receive a lump of $200,000. In this case, that's why the client wanted to set up the trust in the first place. The client didn't want a total of $350,000 passing to her young child and being subject to guardianship proceedings, and didn't want the child to receive it at age 18 when she's probably not mature enough to take care of it properly. Instead, the client wanted it to be managed by a trustee, somebody with the experience and maturity to manage the property until the child is much older. The trust provisions in such a case typically last till age 25 or 30 or 32. The client has complete say on when the trust would terminate, and it would be based on what the client thinks about her own daughter. In this case, it would have been better for the client to change the beneficiary designation at the same time she did her will, so that the death benefit would flow to the trust together with the home. Let's talk a little bit about tax issues. Because of the American Taxpayer Relief Act of 2012, planning for estate taxes has changed dramatically effective January 1st, 2013. For all but the very wealthy, federal estate taxes will no longer be a planning concern. This slide shows you the history of the estate tax exemption since the year 2008. But going back 10 years or more, the estate tax exemption has been changing. Now effective January 1, 2013, we have a set of rules which are not scheduled for change. That means, for the first time in a long time, we can think of the federal estate tax rules as permanent. You can see in 2008 the estate tax exemption was $2 million, and the
tax rate was 46%. And then the exemption went up to $3.5 million. In 2012, the estate tax exemption was $5,120,000. In 2013, it was scheduled to come back at a very low $1 million exemption, but Congress acted early this year and gave us a permanent exemption of $5,250,000, and that will be subject to future inflation adjustments. You can see that the rates that apply once you exceed the exemption are substantial. The rate in 2012 was 35%, which was the lowest rate we've had in a very long time. Effective January 1, 2013, however, the rate has been increased so that once your estate exceeds the $5,250,000 exemption, the rate will be 40%. It's hard for you to have an understanding or appreciation for what this means without having some discussion about what's included in your estate for estate tax purposes. Generally speaking, keep in mind your estate is going to include all the assets that you own at the time of your death, and all the assets that you have control over or that you have an interest in at the time of your death. Let's talk about the Connecticut estate tax for a moment. Keep in mind that for Connecticut estate tax purposes, there's a $2 million exemption. That means that once your estate exceeds the $2 million exemption, the estate tax will kick in and the rate starts at just above 7%.
So if you have a $2.5 million estate, that means the estate tax for Connecticut purposes will be $36,000. Of course, that's an effective rate on the overall estate of 1.44%. So you can see if you have an estate of $4 million for Connecticut purposes, the estate tax would be $146,000. If you have a $6 million estate, the estate tax would be $319,000, and so on. So it's important to keep in mind that there is a Connecticut estate tax. Now, as I said earlier, you really can't have an appreciation for what the estate tax is all about unless you know what property is included in your estate for estate tax purposes. And it's really a lot of different types of property. It's not just the probate property, it's also non-probate property. So you can see here the probate property is included. Life insurance, if you have an incident of ownership, is included. Your jointly owned property is included. Now, for married citizens, half the jointly owned property is included. For married non-citizens and unmarried joint owners, a different rule applies, which we'll try to get to a little later. Certain types of trusts are included, and if you have a trust and you created it, made a transfer to it, and retained benefits for yourself, those types of trusts are included, or trusts over which you retain a certain control over the property that you put in. IRAs and similar retirement accounts are included. Death benefits under annuity contracts that you own are included. So one way to think about it, of course there are exceptions to this, but one way to think about it is that pretty much any property that passes to somebody else as a result of your death should be thought of as perhaps includable in your estate. Chances are very strong that they will be.